Well, folks, the emotional roller coaster of the stock market has now officially entered its short squeeze mode. As you can see, the Nasdaq is now up 10% from its lows, inflation is finally starting to inflect, and my portfolio's unrealized losses are starting to look a lot less red. But as is the case with every market correction, the looming question on everybody's mind is whether or not this is just another bear market rally. And to instill just that extra bit of fear into retail investors, folks like Jeremy Grantham are still pounding the table on a further collapse in the S&P 500, even after their theory has been proven wrong countless times over the past couple of decades. But could this time be different, and are retail investors just getting fooled by big money? And those questions are exactly what we're going to address in this video. But before we get into it, guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So I want to start off this video by addressing a big earnings drama that happened just last night, where one of my stocks, C3AI, reported their full year 2021 results. And as you can see, the stock tanked by around 20% in pre-market last night, even though the earnings report for this company was absolutely fantastic, where they beat both the EPS and the revenue estimates of the analysts. The single reason that caused the stock to collapse by 20% was simply their lower than expected guidance for 2022 revenue. Now, what this shows us is two important things about the current state of the stock market. First, the fact that we have record low liquidity in stocks, because otherwise we would not see stocks issue very good revenue reports and tank 20% after hours. As a matter of fact, we've known about this liquidity shock ever since the start of the year, because many investors have said this before, that 2022 could not have been a worse year for the stock market because the economic situation for the economy was generally extremely strong. And for those that don't know what liquidity means, it is essentially the speed at which you can sell or buy an asset. Essentially, the speed at which you can get a buyer or a seller to take the other side of your trade. And so what that essentially means is that if you're a seller in this kind of stock market, if you don't find a buyer for your shares, you're going to have to bid the selling price of your stock at a lower price than what you had initially anticipated. And so that naturally causes stock prices to go down. And that is precisely why we have seen indices like the ARK ETF crash to the ground from their highs of around $120 a share all the way down to $45 in around 6 months. And there is no other reason why this has happened apart from the liquidity shock that we're experiencing this year. And this whole liquidity problem is arising not from any sort of fundamental problem with companies, but rather macroeconomic uncertainty. So, as a retail investor, what should you do in this kind of market environment? As you can see, Warren Buffett has made his thesis relatively clear. He's been buying stocks over the past 3 months, even though a lot of the indicators that Warren Buffett tends to follow are showing that the current stock market is technically overvalued. And I can assure you that one of the reasons why Warren Buffett has started nibbling into shares is primarily because of the fact that low liquidity has resulted in excessive selling in a lot of his favorite stocks. And as we're starting to get a little bit more certainty on where the Fed could be going with their interest rates in 2022 and in 2023, which is where we potentially expect an actual interest rate cut if the Fed is aggressive enough, we're starting to see the stock market all of a sudden see some sort of relief. Because at the end of the day, certainty is what makes the stock market go up. When there's a lot of uncertainty, that adds volatility and that reduces liquidity as buyers completely step out of the market. And as the prices of assets like real estate are already starting to come down, as mortgage rates have already started to go up, we are starting to see wealth levels decline for a lot of consumers, which should lead us to a path of consumer demand destruction, which obviously is going to tame inflation. But I'm sure you guys have already heard different forms of that argument already. Instead, let's address the bigger picture question, which is whether or not this rally in the stock market is just another bear market rally, which is something we've had many times over the past 6 months. Now, the reason why I don't think addressing this question makes any sense when we're in this kind of market is primarily because as investors, we have no idea whether or not the rally that we're seeing is a bottom or it's just a bear market rally. Now, obviously on paper, this sounds very stupid to say, but if you really think about it, this makes a lot of sense because back in March of 2020, when we were hitting these lows near the 200-week moving average and the market had collapsed 35%, are you sure that the people who were witnessing this massive rally in stocks for the next few weeks following March 18th actually thought that this was just another bear market rally or a dead cat bounce? I can guarantee you that 99% of retail investors probably thought that this was just another relief rally or a dead cat bounce. And the same could be said for the 2018 crash, where the market plunged another 20%. These few weeks right here probably looked like bear market rallies, until obviously the market ended up hitting all-time highs. So the key here is that there is no way that investors will know if the current rally is a bear market rally. And so that is precisely why it pays to simply dollar cost average into your favorite companies if you're seeing good deals in them instead of waiting for the market to go lower. Because at the end of the day, there is no way that you're going to predict if there's a bottom or if it's just a dead cat bounce. Because in reality, the rally that will take us out of the bottom is going to look exactly like a dead cat bounce. So the market rally that we're seeing right now could be one, but again, that is not our job to predict as investors. And so a lot of the people that are pessimistic in the stock market right now, even after this massive decline, those folks will probably not turn bullish until the market already hits all-time highs, by which time valuations for your favorite stocks will already be very expensive. So the key idea here is to continue to buy the dip. And as you can see on the IWM Russell 2000 index, we have already bounced from that 200-week moving average, which also coincides with this prior resistance level that I outlined a few months ago. And on the monthly candle for May, we have closed extremely bullish, right at that 50% retracement on the Fibonacci. So generally speaking, from a technical perspective, this could be the bottom for the medium term. But again, I could be completely wrong because my guess is as good as your guess. But since this index does tend to track very well with some of our small cap growth stocks like NKLA, Plug Power, Bloom Energy, it does pay to investigate this index a little bit more precisely than the Nasdaq or the S&P 500. And so in the short term on this specific index, we could just be testing that prior support level around here before we continue back down to retest 170. But if we start to see a nice move over $200, then that could start putting the foundation for a bottom. Because obviously by that time, we would have broken out of this very aggressive downtrend line and we would have made a higher low. But anyways, guys, that's just my take on the argument around bear market rallies and finding the bottom. Let me know your guys' thoughts on whether you think there's more downside in the stock market yet to come. I'll definitely be very interested in hearing your guys' opinions. But anyways, guys, I hope you enjoyed this video, and I'll catch you guys in the next one. Take care.